I think the idea that AI is going to somehow take out engineering before it takes out other roles is untrue completely in our data. Engineering has been the most healthy and robust part of it's taking share more as a percentage of total hires, more engineers hired last year than we'd seen in like the last 6. So as the tooling gets better, maybe it expands the potential use cases, et cetera. So engineering is the obvious choice there. I wouldn't product as a function, I think, is doing pretty well, all things considered. Maybe as Marc was mentioning, you take a little bit more go-to-market responsibility. You like talk to customers much more frequently, et cetera, et cetera. You become this amalgamated role. That's certainly a possibility, but I don't think don't switch out a product to something else just because you think the salary might be a little higher. Only do it if you don't love what you're doing.
Welcome to another episode of the Supra Insider podcast. In this episode, Ben and I were joined by Peter Walker. Peter is the head of Insights at Carta. And Carta is really cool because they have data on more than 30,000 startups. And his role is to tell stories with that data to help us make sense of what's going on in the startup world. He's one of my favorite people to follow on LinkedIn because his posts are always packed with rich insights and value, which I learn a ton from. He's also beloved by the Supra community. He did a fantastic learning talk for our members last year, and people are still talking about it. In our podcast conversation, we went deep on trends in the PM compensation space in 2024, both in terms of cash and equity, what he's seeing in the PM space, and how does that compare to what Ben and I are seeing. We also talked about how many startup employees are actually exercising their shares when either they change roles or even when they get the chance to. We also compared and contrasted data in terms of compensation for both early stage and late stage startups. And we finalized the conversation jamming on what roles do we think that are likely going to be affected by AI in the next couple of years and which ones do we think are going to remain strong. This was a really fun conversation and I'm sure you'll learn a ton. So enjoy. Amazing. We're live. Peter, so great to see you.
Cheers, Marc. Great to be here, man. Thank you for the invite.
Yeah. So glad you could make it. And yeah, Peter, you're seeing a lot of really interesting data and functions, a lot of startups, probably one of the richest data sets when it comes to compensation or other data on startups. But yeah, the first question that I have for you is, very generally speaking, what interesting trends are you seeing in the compensation space for PMs, maybe in the last 6 to 12 months?
Yes, a lot of ways we could take this. Maybe useful for me to set a little general context here around the data set that we're talking about. So Carta sits on these aggregated and anonymized pool of information from 45,000 startups now. Not all of them have hooked up into our Carta Total Comp product. So the actual population that we get full salary information is a little bit less than that. But it's still, we're talking about 500,000 plus employee records that we can look at and slice and dice in a lot of different ways. So it's a very robust data set. All of those companies are, and for the purposes of this conversation, US companies, and they're all pre-IPO. So we don't work with public companies. It's just from 2 people in a garage all the way up through right before you IPO. And in that world, the biggest thing that happened to compensation for those employees over the last 2 years is that after shooting upwards in 21, early 22, it felt like everyone had 3 different job offers. There was a real slowdown in comp changes. So there was basically flat salaries, and then equity took a real big deep dive. And that's my dog barking. She's so excited about product compensation. Come on, guys.
Those are my people.
Yeah, she's the best. She loves product people.
For those just listening, we just saw the tail just make its way out of the frame, so it's great.
Yeah, you'll see George too, probably in the background at some point.
Yeah,
that's
my dog is just in the background. But if a loud truck comes by, you'll get some barking, I'm sure.
I love it. Okay, so then let's talk about product people. In general, I think product compensation has had a pretty decent 2024. If we look at just salary change over time, we're talking about on average maybe a 1 to 2% increase in salary, which doesn't sound like much, but given where we've been over the last 2 years, which is effectively flat, like any growth is good growth in that, the equity is still, good ballpark figures are like 30% lower than it was if you were hired, say, in early 2022. But it has stopped falling and it started ticking back up again for most product roles. So I think that 2025 will be a better compensation market for a lot of PMs. The real thing, and Mark, you probably know this better than most, is how many PMs are going to get hired in 2025. I think that's the real question, because what's driving all of this change in compensation is just startups are being way more picky about each and every single hire. And that labor dynamic drives everything to do with comp.
Mark, before you share what you're seeing, because I do think you have a unique perspective on this that's way better than mine. Just one clarifying question for you, Peter, is when we talk about the equity being down something like 30% in the ballpark, does that mean just like the percentage of outstanding shares? Is that how you're looking at? So someone that maybe used to, just to use round numbers, get 1%, now they're getting 0.7%, something like that?
Yeah, that's exactly right. And that's a good point to dig down on maybe a little bit. Obviously, equity is intimately tied up to the value of the company. So you could look at this just on a notional value basis and say, well, the valuations of the companies are in many cases down from where they were 2 years ago. So, of course, the equity is worth less. But we're not talking about that. We're literally talking about if Mark was hired in April of 2022 and he got 100 shares from this company, if I'm hired for that exact same role in April or June of 2024, I'm probably getting 70 shares of that company. So it is an actual meaningful decrease in the percentage ownership for each one of these employees.
Yeah. And when I hear this, I love to maybe go deep into like, why do you think that's happening? But like in my head, there's like two potential scenarios. Maybe there's three or four, but one is people are less willing to take risks, like because they may have been burned or have seen these evaluations take big hits. But then if that was true, then I would expect the cash compensation to grow a lot faster, right? Because they would try to supplement like the lack of maybe equity with stronger cash compensation.
Yeah.
The other one that I'm guessing too is that maybe founders are less confident that they can raise their next round. So they're like, oh shit, like I really need to stretch that options pools for employees, and maybe I'm going to be a little bit more stingy. And then plus maybe employees feeling like it's an employer's market. I'll be lucky if I get a job, so maybe I'm not going to negotiate as hard. Like which one do you think it is out of those, or which one am I missing?
I think it's a combination of all of them. The one that we haven't seen basically at all is the one that you mentioned first. So this inherent trade-off in comp negotiations between cash and equity. Certainly candidates these days are walking into these negotiations saying, look, I would rather hold the line on salary than I will on equity. Salary is more important to me. So I do think that negotiation there is maybe more significant to many employees these days than the equity one is. However, the core dynamic is just hiring. Like you cannot, in most cases, push an offer to the very upper limits of the range unless you have another offer to compete it against. How many people are walking in with multiple offers that aren't ML engineers these days? It's just not that many. In a way that in 2021, there were so many stories of people having 3 or 4 offers at the same time and being able to say, look, I have the choice of 3 or 4 great companies. Like, why should I choose you? Much more of an employee-friendly market than an employer-friendly market. Whereas today, it's the opposite.
Yeah, that sounds...
thinking more about it. Oh, you go.
Go ahead, Mark.
Yeah, the other thing that I was thinking about too, like that actually I've seen that trend in the Supra community is actually a lot of people that used to be, or not a lot of people, maybe I can think out of my top of my head, 3 people that used to be heads of product at early stage companies that actually they're like, I understand the startup space. I'm not even going to try to interview with those startups. I'm just going to go for the big public companies that I know they can pay that, big salary and just not even like waste my time. So I think maybe that's also what we're seeing, and maybe why that cash compensation increase is not in that data that you shared.
And like,
Ben, what?
it's just to add on to that point. If you look at the super cycle here of what's happening with startups, there has been this introduction or reintroduction, you might say, of this wave to judge startups, which is ARR per employee, which just was not talked about in 21 and 22. It was grow as fast as possible. And now the mantra is grow as efficiently as possible. Still fast. I think sometimes we are at the risk of saying that growth doesn't matter so much in startups. That's not true. Growth is like the only thing that matters, but growth per employee matters a lot more. And so then the founder is looking and saying, what of my tech stack, what of my employee base can I automate? What can I offshore? What can I do to make it so that I'm being as capital efficient as possible? Because as you mentioned, maybe that next dollar, marginal dollar, is not coming in the door in the same way that it was.
Yeah, that sustainable growth, I think, is just creating a lot more exciting prospects for companies that don't have sustainable growth at the moment, right? Like founders are thinking ahead to the next fundraise. Maybe there's an M&A opportunity on the horizon, but for most companies, I think those are mostly looking like acqui-hire kind of opportunities. And at least from what I'm seeing, I think that the IPO market is showing signs of life, but it doesn't seem like people can bank on an IPO or like a really lucrative M&A event like that would generate liquidity like they did 3, 4, 5 years ago. So my guess is mostly people are looking at the equity as monopoly money that is worth zero, and they can't do any like life planning based on it.
Yeah.
A lot of employees are not even allowed to sell their shares without explicit consent from the company, which is under very clear terms. And they don't want to set like a different price in the secondary market than what they're talking about to investors and their own kind of like behind closed door conversations. All that leads me to believe that the cash is king at the moment for people in the market.
Yeah, this is something that we at Carta, I think, are always beating the drum on for employees. And we can get into the ways that it affects like early stage versus late stage, but in general, you should never ever treat equity like it's cash. It is not cash. Even at later stage companies, it is not cash. As you mentioned, there are a lot of hoops to jump through if you're trying to sell it on secondary markets. You may never be allowed to. Your founder or your executive board can always say no. They always have right of first refusal on every single share. And you cannot bank on an IPO or an M&A. There may even be a transaction, and yet even in that case, the transaction is not material enough to flow down to the employees because there's liquidation preferences or other things on the cap table. So you have to treat it as a ticket, an upside ticket. I wouldn't say lottery ticket because it's a little better than that, but it is an upside bet. And what you make from that company is cash and bonus. That's it.
The one thing I want to add, just for the sake of anyone listening who is just really wants to understand how to think about the equity, is I not only think that it's paper money in the sense that you should assume it's zero, but I think often it should even be seen as a liability if you have to exercise your options before you leave a company or within 90 days of leaving a company. And if you're going to negotiate a lot of options and then you leave the company after 2-3 years, and you have a sizable equity package and they have a 90-day exercise window, and that company never achieves liquidity, you're going to end up losing a lot of money on that equity if you end up buying your options.
Yeah.
And that's something that I think people just think of equity as only upside. But in the last few years, I have seen people unfortunately take a beating on exercising their options and the company just not going anywhere afterwards.
Yeah, and AMT taxes too. Like some people, like if they exercise and they join a Series A and they exercise Series C, you're gonna have a fat like 6 figures AMT bill, which if the company doesn't liquidate, that also goes to nothing and you don't get that return or that credit.
It's hard. It's really hard. And it always comes in waves. As we hopefully, knock on wood, get more IPOs and things next year, I think some of the candidate emotion towards equity will shift. If you're reading about big IPOs in the news and all of the millionaires that it mints, you feel differently about it than if you said, hey, no one's IPO'd for 3 years and none of this is real. So it always comes in waves, but it definitely requires many hoops and is like a personal financial decision.
I'm curious, does Carta have data on like how many people are doing like early exercises? Is that something that you have information on? Is there any?
So there's technically early exercise, as in literally the shares have a clause about early exercise attached to them. And then there's exercises over time before an employee leaves the business. About 11% of ISOs have early exercise attached to them. And that's a pretty employee friendly mechanism. We really like it. It's not everyone. And then if you look at the actual fundamental exercise rate, right now, I think I checked on this recently, of all ISOs that are about to expire. So why would an ISO expire? Mostly because someone's leaving their job. It's usually a 10-year period. So most of the time you don't stay at a startup for 10 years, you leave before that. So you can effectively think of this as what percent of employees exercise their options before they go back to the pool. Right now, that's hovering around 30%, which is as low as it's ever been.
Wow.
Versus 50, something like 50, 51% exercised in the peak times. Now, those two numbers are obviously intimately related. If you exercised your options at a company in 2021, the likelihood that you have seen any value from those shares is basically nil at this point. So if you're at your next startup gig, are you likely to make that decision again? Probably not, because you got burned in the past. So those two numbers, like these things always flow with the cycle, but it is basically very low times for employee exercise rates.
So a follow-up question on, now we're getting into like super interesting area. When I think about all the 30%, was it, you said 30% exercise?
Yep.
Or, okay. When we think about the 30%, do you have a sense of what the primary alpha driver is for folks that exercise over the last couple of years has been? Like, if anyone actually did make money, is it through secondaries? Is it through M&A? Is it through just like those handful of IPOs that we've seen?
It's a good question. I don't know exactly how to break the employee liquidity pie down by type in that way. I could tell you very shortly that it's not IPOs for sure.
Yeah.
So that leaves secondaries and M&A as the two main paths. M&A has been trending back up, but it's very difficult for us to know whether or not those are quality exits or if those exits just happen to be fire sales, acquihires, etc. More and more, there's later stage companies getting bought, so I think that those are probably decent. Secondary is really interesting. We've read a lot about secondary markets being on fire this year. If you strip out the biggest 10 names, they're really not. If you take away SpaceX and a couple other people, like there aren't that many companies that have really strong secondary interest from a giant pool of investors. It's definitely trending back up from 23, so that can be real, but I think a lot of startup employees are waiting for liquidity in one way or the other.
Yeah, I feel like if you're joining like a Stripe or a SpaceX at this point, you're valuing your equity essentially like you would value it if you're joining like a Meta or a Google or one of these big companies, because there's so much liquidity in the market. Those handful of companies.
Yeah, yes, but one, the pool of companies that fit that definition is literally 5. Like it is not you can't be like, oh my gosh, I'm joining this late stage startup. It'll just be like SpaceX. It is not like SpaceX. And then 2, yes, but it is always at the discretion of the management, right? Stripe does not need to run another secondary tender. Never again if they don't want to. It's not like they've committed to doing it every year or anything like that. So it is just not like liquid shares. They do not move in that way. Do I think that the late stage secondary market is like probably interacting with IPOs in a very interesting way? I really do. SpaceX is weird because Elon's his own kind of guy, but let's take Stripe for a second. If you're Stripe, what's the point of going public?
Yeah, or OpenAI, for example.
Why ever do it? More oversight for the same amount of capital that I have access to right now. What's the point? But I do think the latest stage names, it's really hard to imagine why they would go public.
I think the counter argument is that the counter argument to the idea that the additional oversight and public accountability of being publicly traded stifling innovation and stifling growth has counterpoints like looking at companies like Meta and a bunch of other publicly traded companies, or Reddit, for example. Reddit stock is ripping. I just looked at it this week, and I haven't looked at it in a while. And if going public was bad in some way for shareholder value, there's just like so many data points at this point to prove that doesn't seem to be like that strong of a correlation.
I just don't think that that's the calculus, though. The calculus is, why, as the founder, would I add oversight to my work?
Yeah.
I'm with you. I don't think that you can be, I think you can be an incredibly innovative, value creating public company. I think there's nothing wrong with that at all. But if you are sitting down with John and Patrick right now and you're like, they're like, I can be an incredibly innovative shareholder creating private company. What is the push?
Yeah.
Go ahead, Mark.
They're also in the long term too, right? It's not like they're trying to get rich quick. Like they probably want to be building Stripe for a long time. Yeah.
Yeah. They're already quite wealthy.
Yeah.
I think that this actually very much needed is there needs to be a bull case for going public, not a, hey, this is good because it's good for like the American economy, or like you be able to recycle capital. So like your late stage investors care. I think there needs to be a very strong case of it's like being a public company is a great thing. And I don't know if there's been a well articulated case to that effect lately.
Yeah. I think the argument that there's such super strong opinionated founders that are counter consensus who have decided to go public because even if they didn't need the money to do it, that I have a feeling like there are reasons like accountability, like transparency. If people can see what you're building and they could follow the growth of where your company's heading, and your board can hold you accountable in more public ways, and public market equity investors can ask you tough questions, theoretically that additional pressure and accountability will make you stronger as a company. So anyways, that's just my view on it.
I want you to make that case more broadly, Ben, but I will tell you that I do think when you point to the examples that you're pointing to, Facebook, Amazon, etc., the private capital markets were nothing like they are today. You cannot, when Amazon went public, you couldn't raise a $500 million private round. Now you can raise $3 billion in the private market. It doesn't matter. Like, we are just fundamentally in a different place for private capital liquidity than we've been ever. So I want those things that you just mentioned to be true. I don't think there are a ton of people who agree with you. And to be clear, we're only talking about a tiny, narrow slice. Like for most companies, they go public because they do not have unlimited capital in the private markets. But for the biggest possible names, I do think it's a different question than it's been in a long time.
One thing that I just been thinking a lot for the last like couple of minutes is like that like 30% figure versus 70% figure. Like that to me is wild. There's 70% of shares that just evaporate. That people have put like their sweat and tears. They go back to the founders. They go back to the founders. Great. Right. For the founders is amazing. But for the people that worked at it, I mean, they're maybe not worth zero, maybe they're not, there's definitely a risk, but it feels like people are leaving so much value there that I'm almost curious, like, why haven't there been any solutions to maybe even...
Are they leaving value is the question. I think in most cases over the last 2 years, they haven't been. They've been making smart financial decisions. As you mentioned at the top, is the likelihood of my exercise cost being less than the total value created from these shares high or low right now? Low.
Yeah, 70%
of the statistical basis, low. Sometimes you would, if you were at, man, it's this weird thing where you need to already know before you make that choice. If you're at a startup that is growing leaps and bounds and you're like, I can't imagine this. Like if you are at OpenAI, exercise your share, of course. They're probably doing RSUs or profit share units or whatever now. But like that choice is easy. Most employees do not exist in that like binary world where it's like, look, this is going to be great.
Yeah, the way I think, Mark, about that 70% is that from a founder perspective, it can be tough psychologically too, because what it's telling them is 7 out of 10 people or 7 out of 10 units are making their way back to the pool because those people don't have confidence that they're going to make money on this. So what it's telling the founders is they don't believe in where you're taking this company. They don't believe it's going to be worth a lot. And if they did, they would be buying. Peter?
Maybe. No? At the peak, at the bullish, most euphoric part of 2021, this percentage only got to just above 50. So in the best of times, 50% of options are not exercised, right? So it's not, I don't know if founders are looking at that as the signal about what their employees believe about the company necessarily. Let's put it this way. Henry loves to tell this story back in the day at Carta about 10 years ago, where one of the most controversial things Carta did was email employees that their shares were going to expire. And we got a ton of pushback from founders saying, don't send those emails.
Hmm.
Now,
And
today, you
that's in
could
the
not
good
imagine a
times.
founder saying
Yeah.
that, right? You would be like, of course, like, we want these employees to have great financial decisions. We want them to be understanding the matrix. But like back in the day, we got a ton of hate email from founders being like, do not email my employees about this. So I don't know if even today founders are looking at the employee exercise rate as some sort of bellwether like that they need to internalize. Maybe they should be, but I'm not sure that they are.
Yeah, especially if they still have conviction and they're putting everything on that. They have to tell their story that this is good for me. I'm getting more of my company back. And I think that's the story. But I think to me, the really interesting part is I feel in today's market, people are operating from out of fear. Like they're just like, they feel like their job could evaporate at any point.
Yeah.
They're not sure if they're going to be able to land that promotion. That's going to, maybe they just had a kid, whatever. And I think there's a camp of people of the 70% that like, they look at the company performance. They're like, yeah, this company is not going anywhere. Absolutely not exercising. But there has to be a small percentage that are like, this company is going somewhere. I believe what they're doing, but there's definitely still like maybe 7 or 8 years from a liquidity event. And right now I cannot afford to tie 5 figures or 6 figures into this thing that's not liquid. And I think like that to me, that's really where the opportunity is, because they clearly have information. They know it's coming somewhere. And it's just sad that because of the liquidity of these shares, you're just have to forego all this value they've created over maybe 2, 3, 4 years.
Yeah. Private markets, I don't want to have my stridency earlier suggest that I think everything is rosy and not as functioning perfectly. No, it's not. There are definite like room for a ton of innovation here on private shares. I'm with you. Like a part of this is just the cash value, the time value of money, excuse me, which is I believe, but do I believe so much that I couldn't put this $18,000 to better use in the next 5 years? That's the real hurdle that you got to jump over.
Peter, are you seeing any noticeable differences just coming back to the data between like the IC? I'm guessing you guys have breakdowns in your systems between IC PMs and more like leadership level PMs, or are you seeing is that kind of like 30% difference that we talked about equally applicable to the ICs in the data and the people managers like VPs, CPOs?
Yeah, so I just looked at this morning. So if you just look at product folks and we're talking about valuations of standard early stage markets like 10 million to 100, 150, something like that. Interestingly, the differences in equity, there's some significant differences in equity by role. So first off, we'll talk about leadership first. There's been a just slight decrease for VPs, SVPs a little up, C-suite never really goes down. Always pretty high. So that market is effectively flat-ish. What we have seen is entry, like very junior ICs, entry and maybe the level above entry, their equity has fallen. But the senior IC to like low manager has seen the greatest increase in their equity. So that does suggest to the theme that if there are fewer people, fewer PMs being hired, maybe the earliest PMs are losing out a little bit. And the ones that are like established and perhaps adopting new technologies very quickly, et cetera, are seeing a little bit of a bump. I think that's still maybe a conditional finding, but it does track with the engineering compensation, which is the place that you would look next probably to see some of that same change.
Yeah, that makes a lot of sense. Go ahead, Mark.
Yeah, no, I know you asked what trends was I seeing going into 2025. And yeah, I think, again, I don't want to make predictions. I don't know what's going to happen in 2025, but I definitely like the trend that I've been seeing establishing in 2024 is, yes, that I think the people that I see really struggling are like the people on both extremes, like the really early stage, like career PM, right? There's just not that many roles out there. Like people, hey, I don't have the bandwidth to train you. I cannot take the risk to have someone who's like junior. And then the very senior people are like, actually, sorry, we're like really flattening our org. We're not launching new product lines.
Yeah.
And we also want someone who actually has been in the ground and done the work and can get their hands dirty. And there's been a lot of those VPs, C-level executives that actually are just managers of managers that haven't really done the work for a long time.
Yeah.
And then to compensate, what we're seeing is instead of maybe hiring 2 junior people and maybe one low level, like a group PM managing them, they just hire like a principal PM that can do the job of 2 or 3 people, pay them a little bit more. And that gives a result. And that also allows us to get rid of a layer.
Yeah.
And then the other insight that I'm curious if you're seeing in your data, it's like the rise of like the fractional product advisor or CPO, where I think that's delaying how quickly you need to maybe hire a head of product or something like that.
Yeah, the fractional data set for us is a little bit tricky because of the equity lens. At the very earliest stages, if you're bringing on someone fractionally and not giving them equity, which does happen, although it's more rare, we don't even see that person. So I'm sure it's happening a little bit more frequently than we can see. The roles that are most, how do I say this? The highest frequency of fractional roles is actually, I don't think product is a very big one. HR is the function that has the highest level of like executive fractionalization from like series A to B, where companies, yeah, we know we need a people person, but we don't know if we need a people team. So let's do this fractionally. Product doesn't generally follow that path. Product and engineering are pretty rare to fractionalize. But in a weird way, product sits in the middle because engineering, we are seeing some companies do the offshore thing where they're like, we're just going to have a complete team. There's not going to be in our current country. So we'll do some cost arbitrage that way. Product isn't generally a giant part of the organization. It's 4% of headcount to 6% of headcount, something like that. So it's typically in-house full-time employees are on product. There's just not that many of them. So I don't think we've seen a giant rise in fractional product roles. I think the thesis about the Supra IC makes a ton of sense logically. It also makes me sad. What are the junior product folks going to do here?
It's a
VPs,
big topic.
they're already one, etc. But if you're just coming out of college, that I really hope there's a way for you to get involved in startups as a product person.
This is something that we spend a lot of time. I think a lot of us are seeing the same thing, especially because Supra is catered to the high end of the seniority scale. A lot of us are wondering what's going to happen to the entry level PM or junior PM path. And actually, some of my friends and folks I've mentored in previous companies are on that slightly more junior PM side with maybe 1 to 2 years of PM experience, and they're not getting hired. A lot of them are looking at switching, so just getting into other kinds of cross-functional roles at companies that are doing well, and maybe they're like open to product being a thing they tried for a while, and that's actually not their long-term path because the demand for their level, their amount of experience, it sucks. I'm not laughing because I think this is trivial, but I'm laughing because it's a shame. And I think that there's a lot of people who just don't want to take a risk on someone, and none of us would be where we are if someone didn't take a risk on us, because you cannot study product management in college. So every single one of us got our first PM job because someone thought we had the chops to be good at it. And it's a shame that people are not feeling like they could support people to get into it anymore. Mark, what do you think about it?
Yeah, no, I think it's, as someone who got into PM early in my career because someone took a chance of me, I think it's a really sad trend. And unfortunately, I think AI won't help with that. I feel like AI is going to get really good at those like entry level, like maybe aggregating, project management, that I think maybe a lot of these people were doing as a starter project. And then overall, you were like increasing your scope and your critical thinking.
Yeah.
But yeah, I think if I were going to give some advice to someone who's like, how do I break into product? Be like, get a role in a place that's at a function that's customer facing. Get really good at talking to customers, getting insights from them, because I think that's probably the last frontier that we're going to see, like delegating of like how to be really good at deriving useful insights from customers. I think that's going to be really hard. So I think if you can get those reps in.
Yeah, there's this thing that goes around whenever we talk about this, or whenever I talk about this kind of stuff, where it's, yeah, but those people should just be founders anyways. Like, it's the age of the solopreneur. Go out and build something yourself. And yes, we get it. That's a beautiful path for the people who want it. A, not everybody wants that. And two, some of the best founders were trained at early stage startups. Like, you still want this as a proving ground and like an apprenticeship to learn the craft of product making. I worry about that for a lot of functions, but I worry maybe even more particularly for product. It's like, what is the pathway for entry level people? I think is a thorny question.
Yeah, I think product management and the product design are the two that I'm like, yeah, these people are in trouble.
Yep.
Yeah, and then Mark, to your point about the other end of the extreme, on the really senior executive side, people who, let's just say folks who are maybe a little bit rusty on rolling their sleeves up and getting like the ICPM work done. Also seeing that there's not that much demand for the kind of ivory tower exec that just directs people to do things. Are you seeing any, is there any way to connect that trend to the data? It's hard to imagine what that would look like, but
it's
like people joining companies with like at the C level, but no direct reports or something like that.
That is an interesting question. I feel like the other thing that they would do is maybe they were an exec somewhere else, but now they've taken a title drop and had to working at a smaller place. So I haven't looked into that closely. Maybe we need Jason Saltzman at Live Data to help us out on that one. But I bet that's happening. In the comp side, we're not really seeing much impact to exec salary. Product exec's salary was up on average over the last, call it 12 to 14 months, up like 4%, 4.5%. That's pretty strong. But again, it just comes back to who's getting hired, like how many of these positions are getting filled, et cetera. Maybe we're being a little too doom and gloom, and what we really need to trust here is human nature. Like, once the funding comes back, the hiring comes back, and people will just do it that way. My instinct is that's true, but only up until the point. And then you really start talking about the topic that we have yet to mention, which is AI. Like, how does AI fundamentally change these roles? I think we will only know exactly what the impact of AI has been once funding gets healthier. And then you can see, does that capital efficiency message hold in a world where you can actually get funded? Maybe not.
So actually a follow-up for you on this, where we're on this AI funding cycle. So like the context is, my sense is we're something like maybe 2 years in to an AI boom where AI startups are being held to different standards and have access to different capital pools that are like almost like 5 years ago or 3 or 4 years ago, whereas non-AI companies are in a completely different world. So it's a tale of two cities.
Yep.
And so my question for you is, and I know we're speculating because there's probably no data that can validate this one way or the other, but do you think that there is something to be said that the AI, that we're in like a bit of an AI bubble, and that there's just like an unsustainable number of companies that have been funded in AI, so therefore there have to be a lot of them that just go under?
Definitely. But whenever people ask that question, my question back to them is, how is that different from any other moment in venture capital? VC businesses go out of business. That's actually what they do the vast majority of the time, right? So this is an industry that from the outside looks incredibly wasteful, because it is. But the waste, as long as you have big enough hits, is justified by the big enough hits, right? What's weird about VC is that it's become so narrativized. There's so much talk and discussion about venture-backed companies that I think 10 or 15 years ago would have felt really weird, because everyone would have looked around and been like, why are we spending so much time? Like, all these companies are going out of business. And we just have to wait for the ones to emerge, and then we'll talk about the ones that emerge as like impactful to the American economy, et cetera. Whereas now VC is just, if there's one thing that VC is great at, it's talking about itself. And they have made it be like the quote unquote default path to entrepreneurship in America. And that's a little odd. It's a weird industry where if you're hitting at 2 out of 10 of your companies make it, you're like the best VC in the Valley. So I don't know. I think that, yes, there's going to be a ton of money wasted on AI. Maybe that's a terrible thing. Maybe you need bubbles. I don't know if you've all read the new Stripe Press book on bubbles. Really interesting, but the idea that actually bubbles are a good thing. And if you look at the, say, bubbles of the .com industry that laid the dark fiber that Google needed to build data centers across the world and make so much of what we do today possible, like some of that maybe is just people talking out, trying to explain that they didn't waste a lot of money when they did. But I think it's tough to say fully like what is wasteful.
Another trend that I'm seeing, and I'm not sure how much of if you're getting access to that trend, is like the rise of like bootstrap companies and like almost people like being like, oh, I don't need to raise money. I want to be like a 2-person company, whatever. I'm curious if you're seeing any of that in your data at all, and or your clients are mainly.
We are. It's tough to say because we can't really look into the mind of a founder and say, okay, you raised one round. Are you planning on raising another one? We don't, it's impossible to know. Obviously, the timelines for those rounds have been extended, so it's taking longer between those rounds. And anecdotally, yes, we are hearing a lot of people say things like, I want to raise one round and be done, or I'm just going to raise from angels and I'm going to see how far I can make it. And maybe I go back to venture when I'm really quite significant and then I can deal with them on my own terms. So yes, I think that's happening a lot. It's tough to know exactly how that's going to shape out in the data. We do know for sure that the benchmarks that VCs are using to judge companies at every stage have gotten a lot harder. The days of having $1 million in ARR and being able to raise a Series A, that's on. You need 2.5, 3 times that amount these days. And obviously it interacts with your growth rate, et cetera. But the competition at early stage venture is very high.
Maybe not to wrap on a positive note. I think a lot of people probably hearing this is, I don't know if I want to touch private startups. It sounds pretty bleak out there. But yeah, what encouragement signs are you seeing? And maybe we can segment it by stage, or what are some exciting data that you're looking at? It's like, oh, this is cool. Let's hope it keeps going that way.
Oh man, there's so much interesting stuff happening at early stage. As I mentioned, the idea that, oh, this early stage is getting much more competitive also has within it the inherent assumptions like, wow, these companies are growing really fast, some of them, and like at really crazy capital efficiency rates, and like they're building in really interesting ways. Some of this optimism is like, what do you really think about AI? If you believe that AI is this like new technological wave that we have only just started to figure out how to productize, then there's so much more growth ahead. Even if the models didn't get any better from where they were today, you've got so many different ways to productize and implement them into real people's lives. And a lot of that has actually, I think, benefited the consumer over many of these companies, which is really cool. On the comp side, I do think if we're looking ahead to 2025, I would be shocked if 2025 wasn't a better year for funding, a better year for hiring, and a better year for exits than 2024 was. It would be a complete surprise to me if we don't have a better 2025. So in that way, I think maybe 2023 was like the hardest part. Now 24 was okay, and 25 hopefully a little bit better after that. So I'm inherently optimistic about what's going to happen over the next couple of years. But I'd just be super shocked if we just regressed.
Yeah, that makes a lot of sense. I'm also very bullish for how next year is going to go. Hopefully I don't eat my words. And then one more question I know some of our listeners are either on the market considering a change potentially outside of product management, or some people that listen that just work with product managers and other kinds of functions. I was just going to ask you if there is a function that is almost like sticking out as on a just really positive trajectory. Are you seeing something like data science or design, or is there any other kind of like function that seems to be almost outpacing the other functions in the data as far as like salary growth and maybe even equity growth?
The obvious answer is AI ML engineering. I think the idea that AI is going to somehow take out engineering before it takes out other roles is untrue completely in our data. Engineering has been the most healthy and robust part of it's taking share more as a percentage of total hires, more engineers hired last year than we'd seen in like the last 6. So as the tooling gets better, maybe it expands the potential use cases, et cetera. So engineering is the obvious choice there. I wouldn't product as a function, I think, is doing pretty well, all things considered. Maybe as Marc was mentioning, you take a little bit more go-to-market responsibility. You like talk to customers much more frequently, et cetera, et cetera. You become this amalgamated role. That's certainly a possibility, but I don't think don't switch out a product to something else just because you think the salary might be a little higher. Only do it if you don't love what you're doing.
And are there any functions that are almost like on the way out based on the data, or it's looking a little bleaker for other functions because there's just like less and less people getting hired into those, or headcount is going down?
Don't hate to say it, but like we will see what happens to customer support over the next few years. We will see what happens to more administrative functions. In the boom times, the share of engineering and sales hires dropped, and there was a corresponding boost in hires across all different kinds of functions. In 2024, we saw the exact reverse. So the share of engineers went up and the share of salespeople went up as a total population. So the builders and sellers, especially at early stage startups, are like always the people that get hired and have more opportunity. If you're not in those two roles, and I would include product as a builder, it's tough. It's tougher.
Operations, I feel like that's another one that I think like probably is going to suffer over time too. It's one of those like functions that like a lot of times you just throw people at the problem. But yeah, those all resonate.
We're wrong, and there's or maybe it's literally just, hey, if you get funded, you go on a hiring spree. It's not like OpenAI, for instance, has stopped hiring people.
No.
They're opening offices like every week. So maybe this is all just a function of a downturn, and as things get better, hiring pops back because we're all human and we like working with people. Could be.
I'm feeling good about 2025, but again, I don't want to eat my words. So we're all let's manifest it. Anyways, this has been amazing. Two final questions for you, Peter. One is, where can people find you?
I am all over LinkedIn. That's probably the best place to find me. So it's Peter Walker at Carta. I should pop up.
Amazing. And also, if you see any AI generated comments, delete them. I know, Peter.
That's right.
Yeah, I'm with you now. Every time I see one.
Horrendous, man. Like all these platforms are dying because half of the responses are clear bots and AI stuff. It's terrible.
Yeah, let's not let it ruin one of the best social networks out there. And then the second question is, how can our audience be helpful to you?
Oh, man. If you're a founder, hopefully you're using Carta to manage your equity. That would be great. But otherwise, like maybe a little bit of standing on a soapbox here. There's a lot of things around equity when we talk about compensation that I think we're talking about that exercise rate, for instance. Some percentage of that exercise rate is just a lack of education and not understanding what this equity really means, not understanding how it becomes cash over time. And what we don't want is for employees to look back on decisions they made 10 years ago and be like, wow, I really wish I had understood more. I really wish I had more information. So if you're a founder listening in, like, I do think it is the responsibility of a founder to make sure their employees really get equity and what it means. And sadly, I think that it's actually still a way to stand out as a founder, to be heavily invested in educating your employees about equity. So whether that's on Carta or whatever platform you're using, whatever, just if it doesn't come from the founder, then sometimes it's easy to forget what this ownership can mean. But when it works, as we hopefully have IPOs next year, there's going to be people whose lives are completely transformed because they got equity in a company. We want to make sure that that's real for a lot of people.
I love that.
It's great advice.
Amazing.
And I would tell people to consider extending your exercise windows, because 90 days feels a lot of, like, really tight.
I know we understand that it switches your grant from an ISO to an NSO, and there are tax implications. I get it. But for instance, at Carta, our exercise period is indexed to our tenure at the company. The longer you stay, the longer you have to exercise. I love that model.
Employee friendly.
We created a perfect Christmas wish list. Hopefully someone's listening.
Exactly.
Amazing. This is a wrap. Thanks so much, both.
Yeah.
Thanks, Peter.
Cheers.
If you enjoyed this conversation, please share it with someone who you think would benefit from it as well. We really appreciate it. We'd also love a follow or a rating on Substack, Spotify, or YouTube. That's going to let other people find us. And if you have any topic recommendations for a future episode, please send myself or Mark a DM on LinkedIn. We'd love to hear from you. Thanks.